Hello friends, welcome to my YouTube channel. My name is Amrin Munaf Lurania. I am a student of SAS Institute of Management Studies MMS second year. Today my presentation topic is capital budgeting and Professor Manish sir. Now we start with introduction. The process of capital budgeting is a vital to any responsible, well-managed business. The capital budgeting is a technique of marketing decisions for investment in long-term assets. It is a process of deciding whether to invest or not to invest and the fund in a particular assets, the benefits of which will be available over a period of time longer than a 1 year. For example, the purchase of a new equipment and purchase the delivery vehicles. Now we discuss the definition. The capital budgeting is the planning process used to determine whether an organization long term such as a new machineries and replacement machinery, new plant, new product and the research development project are the worth funding of cash through the firm capitalization structure. Now we discuss the some objectives of the capital budgeting is to maximize the shareholder value. Second is the evaluating the investment opportunities. Third is managing the risk. Fourth is allocating the resources and fifth is the long term planning. This is the some objective of the capital budgeting. Now we discuss the some features of capital budgeting. First is the organization usually estimate a large profit. Next is the process involves the high risk. It is a fixed investment over the long run. All project requires the significant amount of funding and there is the long duration between the initial investment and the expected return. The investment made in a project to determine the future financial condition of an organization. Now we discuss the some limitations of the capital budgeting. It is the inadequate investment make it difficult for the company to increase its budget and its capability. The capital budgeting involves the large number of funds, so the decision had to be taken carefully. The decision in capital budgeting are not modifiable. It is hard to locate the market for an capital goods. The estimation can be respect of cash outflow and the revenue savings and the costs attached which are with project. Now we discuss the some methods of an capital budgeting. First is the average rate of return. In this method, the method is one of the traditional method of evaluating the project proposals and calculate the average rate of return on an average investment. It differs from the other capital budgeting techniques because the focus of this techniques is average and annual net income or accounting the income rather the cash flow. There are the formula of the average rate of return is an average annual net income divided by the average investment. The annual income is sum of all PAT divided by the number and where the N is an economic life of the project. The average investment is equal to initial value plus ending value divided by 2. Now we discuss the second method is an payback period method. Payback period is the time required to recover the initial investment in a project. It is a simple additive method for assessing the worth of a project. Third is the net present value is an NPV. Net present value method is a discounted cash flow approach of the capital budgeting. The net present value of an investment proposal is the present value of the proposal net cash flow less and the proposal is initial cash outflow. In formula we have the net present value. The net present value equal to present value of cash flow minus the present value of an cash outflow and where the K is required to rate of an return. There's a cash flow 1 divided by 1 plus k plus cash flow 2 divided by 1 plus k 2, and the cash flow 3 is a 1 plus k 3 minus cash flow. Now we discuss the next method is an profitability index or the benefit cost ratio. The profitability index of a project is the ratio of a present value of future and the net cash flow to the initial cash outflow. It can be expressed as a profitability index is a total present value of cash flow divided by the total present value of a cash outflow. The last method is an internal rate of a return. The internal rate of a return for and the investment proposal, it is a discounted rate that the equipment the present value of the expected net cash flow with the initial cash outflow. If the initial cash outflow or the cost occurs at time 0, it represented by the rate, the IRA that. Now we discuss the one example of an capital budgeting. There are the two investment in consideration of each of a 4 lakh, and they are expected to generating the following cash flow after the tax. Here is a 5 and there is a two machines, that's A and B. The cash flow are be given and we have to given the 10% rate of return. Now here we have to calculate the net present value, profitability index, payback period and average rate of return. Now first we calculate the net present value, but we have to first construct the table and we have to given cash flow of A and B. So we have to calculate the cumulative of cash flow of the machine A and machine B, which have been given. Machine A, the cash flow is in 15,000, 19,000, 1 lakh 15,000, 1 lakh 19,000 and 2 lakh 25,000. So its cumulative is in 15,000, 1 lakh 40,000, 2 lakh 90,000, 4 lakh 80,000 and 7 lakh 5,000. And cash flow after tax, the machine B is in given 1 lakh, 1 lakh 10,000, 1 lakh 40,000, 2 lakh and 2 lakh, and its cumulative is in 1 lakh, 2 lakh 10,000, 3 lakh 50,000, 5 lakh 50,000 and 8 lakh 10,000. So here now we calculate the net present value of an A. It's a 5 lakh 1,935 minus 4 lakh. So the net present value of a machine A is an 1 lakh 1,935 and the machine B is an 1 lakh 84,960. Now we calculate the payback period. The payback period of an A, it's a 6.95 and B is an 3. So it's a 3 year and 6 month and B is an 3 year and 3 month. Now we calculate the ARR and PII. First we given the table, so we have to given a 10% of rate of return. So we have to calculate that at the 10%. So the PV of the cash flow after tax A is an 45,450, 74,340, 1 lakh 12,000 and 650 and 1 lakh 29,770 and 1 lakh 39,725 given. So the cumulatives are the 4 lakh 45,000, 1 lakh 19,790, 2 lakh 32,440, 3 lakh 62,210 and 5 lakh 1,935. And B also been given the cumulative, that is a 90,900, 1 lakh 81,760, 2 lakh 86,000 and 900, 4 lakh 23,000 and 5 lakh 84,960. And now we calculate the average rate of return. So the average rate of return of a machine A is a 1 lakh 41,000 divided by 2 lakh. So it's an 70.5%. And machine B, so the average rate of return is a 1 lakh 62,000 divided by the 2 lakh. So it's an 81%. And the profitability index of an A is an, now we calculate, so profitability index of an machine A is an 5 lakh 1,935 divided by 4 lakh. So its profitability index of an A is 1.255 and profitability index of an B is a 5 lakh 84,960 divided by 4 lakh. So it's a 1.462. Now we calculate the all values, but there are the some parameters. Due to that, we have to decide that which project is an best. So the payback period we have always calculate the, and we have to consider the lower and average rate of return. Higher is an better, net present value higher is an better, and the profitability index is the more than 1. So in the project A, the payback period is a 3 year and 6 months, and for the B is a 3 year and 3 months. So the project B is selected because it's the less, and average rate of return the project A is an 70.5 and B is an 81%. So we also now the selected the B because it's a higher, and net present value for the project is a 1,01,935 and for B is a 1,84,960. Now we also select the project B because an higher better in B, and the probability index of project A is a 1.255 and for B is a 1.462. Now we also the select the project B because it's a more than 1. So overall the project B is an best. And thank you for watching my YouTube channel.